climax. The market's got structure. And then on the right-hand side, we have a selling bar here. On the right-hand side, we take that bar across like that. Okay. Take the bar like that. And it gives you, so this is not reverse absorption. It's not absorption because we have selling in the background. And it goes against a selling bar. Look at the volume drop off. So the change of character of the daily chart is the volume decreasing on the retest rally after coming from selling. So you got to consider the area. This area here is all a sell. The volume, all a selling area. This is why this is distribution or a lack of upside progress to market versus absorption. The market breaks. This is longitudinal and not supply. So we are in the trade range. Back into it. Notice I said earlier, 3 to 5 bars above it is probably not an upthrust. It's not an upthrust per se. It's just a market. It's a matter of distribution because the low end close, mid range, low end, weak rally, and the volume decreasing. The market decreasing to the market on a small range, indicating this range being controlled by the CM. Range is controlled by the CM. Let's give a small range against the selling. Boom, boom. People look at this as a spring, but a spring coming from weakness generally will fail. Okay? Spring will fail from that particular market. Okay. So from weakness, weak rally, fusion market comes back down, spring condition, but from weakness, not necessarily good. Market then breaks. And now we're in this area where we should not see much of a rally attempt, a large range and volume to the market. Okay? So that's the daily chart. We go back to our 4-hour chart. Again, we talked about this earlier. We see the selling bars. This is where we all started this area a couple weeks ago. We see the selling. Look at the larger bar of the selling. Now, in the stock market, you see that because people tend to panic more. But they start seeing more pronounced selling and more of it range-wise. It generally gets you to a point to where that's all. So we get to the point to where the market now is at a level to where we see distribution. You see the markets. This is the perfect distribution. The market could actually have accumulation here. The kiss of death becomes here, markdown, and this is why this spring generally will tend to fail because it's coming from weakness. Look at the supply coming in or the extra selling come in. This is why the spring gets retested because it's a market that springs from weakness to high volume. This bar here is not a bullish bar. Even though it's a strong volume bar at the upside, the range should be wider. So we're always comparing the volume relative to range. Okay? We're comparing volume relative to range. Okay? Volume relative to range. So there's another weakness. So in all time frames, as they get more and more pronounced, you see as we go into lower time frames, those bars are the catalyst to potential markets to break to more smaller term breaks, in which this leads to 240, leads to weakness on a daily, to the weekly, and also the monthly. Since the monthly is only in the middle of the month, briefly I'll show you the monthly. And we're not there yet, but the monthly potentially could have, we've been up like almost every day, but the monthly still has that vertical absorption in the markets. But you can see on the monthly chart, you have caution of being overbought. You have caution on the market just being overbought to the market. Okay. And you see, it shows that all these are high-end colors of absorption. So the key will be, if I put the volume in on the monthly chart, this volume here last month, again, this could be a little climactic, it's a high volume. Take out this month, this low rather, the market. And it could undo several months worth of work to market. So even though the monthly will turn last, obviously, with all the other markets before everything else, okay? So we see signs of the break potential, the supply potential to the markets. Okay. So keep that in mind, because it's something in which we're going to go through the process of it. Okay. We're going to go through the process of that. And when we go through that process of the market, we can see that again, the beginning of the market will ultimately to the larger aspect of the market, right? So short term. Right, that's the stock market. Again, potential change in behavior in the stock market. One of the things that's important, well, I'll do the bonds first and show the correlation. The bonds, as we see, they raise interest rates, or they cut interest rates, right? And it becomes, people, a lot of people have complained, the President of the United States, Trump, complain that interest rates are too high. They should be cut. The reason why they're not lowering interest rates, I could be the first one to tell you this, but we want to do a special webinar, is simply because if they allow money to get cheap and people start to borrow, like they did in the 2000s, they will not be able to pay their loans back. So they lower the price of a loan too cheaply and make money too cheap by cutting. It will mean that more people will borrow, and they're borderline people that could borrow, but barely qualified. Remember 2000s, we had no doc loans. We had to show income. Well, they tighten up a little bit now, but if they make interest lower, more people will qualify for loans. And I think the reason why they don't do that is because more people qualify, more people will borrow to pay bills or to whatever, and they will default on those loans. So keeping interest rates fairly high relative to what the economy is discourages borrowing of money. And it's a very important aspect of the market, which is why they never really got bullish on the bond market, because they don't want people to borrow unless you're qualified to borrow to a great degree, where you have like 2 or 3 times over to borrow, not just someone that's borderline to get in. So as we see lower, this is monthly, right? As we see lower prices, that's higher interest rate to the market. Lower prices, higher interest rate to the market. Okay. So we're keeping the market fairly benign not really going up to the market. And we'll see how the market begins to continue to go forward, right? That's what it wants to do. Okay. So all that very, very significant. All that to a point to where it becomes something in which this is why interest rates are kept fairly high. I think because of that reasoning of the market itself. Okay. So bonds, if interest rate, if bonds go down, interest rates go up. If bonds go down, interest rates will go up. Okay. So the bond market. Usually with higher bond prices, it correlates to the euro currency. Now, so higher interest rates will mean money flowing into the country that's got the higher rate. Since the U.S. has the higher rate compared to other countries, okay, at this point you're seeing money go in. This will not be the, well, even daily is one point. Then we'll see the whole trending. So if that's the case, you will see the dollar gaining strength and the euro losing strength. Okay? So in this case, you see the decline over the last 2 months, the dollar gaining strength relative to the euro. That's higher interest rates. It makes the dollar, US dollar, more attractive. It makes the dollar more attractive. Which is why you see what you see as far as the bond market correlation to the euro currency. Okay, important. Now, that leads us to something important. I mentioned this several weeks ago about Bitcoin. One of the things when a market is changing up behavior is the excesses get sold. What do I mean? The NASDAQ market, more speculative markets, that begins to many times get sold. Okay, the NASDAQ market. Those are more speculative stocks rather than the S&P 500. The Russell Index, which is more speculative than NASDAQ, gets sold. The market that tends to hold up the most is the S&P 500 of established companies that occur. Okay? Of established companies that occur. So, as I mentioned to you for a long time, the Russell's been lagging. I mentioned the other day, the NASDAQ has been underperforming the S&P 100. That's that change of character and change of behavior of distribution that I think you're going through right now in the market. Okay? So we have the bond markets basically going a little higher. We have the U.S. dollar getting stronger or the euro getting weaker. So everything, you get pieces of a puzzle, everything correlates to each other, right? And then when people get a little nervous and they see that, we now get to the point to see, okay, what is actually happening is the money flow thing. Okay? We become a money flow thing. Well, then the market will come out of the speculative issues, and one of those speculative issues is Bitcoin.